Hello, ladies and gentlemen, and welcome back. Well, markets have actually started to show some weakness. They've come off our expected weekly options high, but it seems like everybody's just talking about one sector, and in the market, this has been the strongest one. So it's probably something we need to look at for potential signs of weakness. It's got to be AI. ChatGPT, everyone's talking about it. What's the logical conclusion for us to ask a question? Well, of course, a few people over on Twitter decided to ask it, when will the stock market crash? According to ChatGPT, it's coming up very soon. It's the 15th of February. On top of all of this, we see Google coming out again with a new technology. It's called Bard. Was it the most expensive employee probation of all time? Well, it made a mistake. It cost Google $120 billion in one day on their stock, and it shows us how fragile the markets really are right now. We've had Nvidia hit critical zones, Tesla hit critical zones, and of course, Google sell off in the last 24 hours. So what does it mean for stocks, commodities, and cryptos moving forward? Well, welcome back everyone to the Daily Show, where we talk about markets around the world. We've got the news, the macro, the lead indicators, and of course the key levels that you need to be watching coming up in today's show. But let's begin with the same old. Disney stock, it's going up after hours, but realistically, it's because they're going to sack more people. And this is pretty much the main story of this earnings season, it seems. Everybody is coming out with lackluster or just kind of beating or hitting the targets that were set. They're not very high targets, by the way. And then they say, but don't worry, we're going to sack a bunch of people. This is the beginning of what we always see, which is probably going to be a very questionable Q1, Q2 earnings season. I'm always interested to see what your comments are down below. So definitely let us know what you think about Q1 and Q2 earnings season this year coming forward. We've also seen Goldman Sachs come out with a pretty big call. We've talked about US recessions being pretty much a sure thing. They're saying, and the caveat here is the next 12 months, that they only see 25% odds of a US recession over this period of time. Now, I'd be interested to see what they think about, maybe a 14 to 18 months away. But it does look like Goldman, at least, is calling that it won't be called this year. Does that really matter, though, for our discussions about investments? And the answer is not really, because by the time a recession is called, you usually will have already seen the low. This is the discussion we need to talk about this year. When will the Fed hit a terminal rate, that is the highest interest rate? And then once they hit that rate, when do they begin the cut? Because traditionally, the lows or the best times for most investors should be somewhere through that cut stage. Between the 1/3 of the way through the cut to the 2/3 of the way through the cut tends to be A-OK, and that's the best zone. Here are the updated figures for what was seen over the last little bit, and you'll notice that there's been quite a switch through February in terms of how many cuts we're going to get and how long we're going to stay at the higher rates. You'll notice 5.1% is now the terminal rate. Here in Australia, that's gone up to about 3.8 as well. So there's some big moves across central banks all around the world. We've already brought this chart up before, so we won't say too many things about it. But basically, it's forward EPS growth, and that's turned negative for the first time. Usually, this predates some market kind of issues, and it's only happened 5 times since 2000. So it's something to be paying attention to. Also, we discussed this in the last video, and that is US BBB rated corporate bond yields to the 90-day US Treasury bill yield. And you'll notice that, again, it's reaching some illustrious history points, usually not being good for the market long term. Now, this brings us on to the pivot discussion. When the Fed hits terminal rates, what has the market tended to do in the past? And then, of course, what's happened after that? Well, it tends to get shaky. And then as the cuts come through, it tends to do poorly. Now, no time is the same, but I think it is fair to always assume that by the time we actually get an official recession call, markets technically usually have already bottomed through or very, very close to bottomed through. So we're more interested in when we hit the terminal rate and how the market reacts after the rate cuts actually come through. This is an investment focused section, of course. Traders, look forward to the end of today's video. It's a totally different discussion because, of course, we're talking way smaller timeframes. Here's a great chart that we shared already, which is median when yield curve is not inverted versus when it is inverted. And this is from the Daily Shot. If you're interested, you could follow them over on Twitter. And basically it says here, when it's inverted, we usually tend to see rises. Well, guess what? That's what we're tending to see right now. We see kind of kangaroo style markets. Interesting. And we're having that right now, a sideways market that's up, down, and all around to expire as many options worthless as possible. And then when we actually see the first cuts come through, well, the results aren't exactly positive as long as we're inverted. And of course, we know we are heavily inverted right now. Percentage-wise, stocks are incredibly inverted. So make sure that if you haven't already picked up stocks at cheap prices and they're not in your investment portfolio, that you consider these things in the future. Have we seen the lows? That's a big question. Have we actually seen a pullback? Not really. Not since, of course, the beginning of all of this, realistically, which started in 2023. And more importantly, are we cheap in the markets? I always like to look at forward PE. I've mentioned it so many times, but I really wanted to bring it through. And I'm going to talk to every one of you out there. Traders, we never care about where the prices are at. We just want opportunity. Trade investors, you guys just want to buy the dip and hope the thing YOLO ups as much as possible. That's actually a pretty dangerous technique. Investors, you really do want the best prices. So how are you going to build a system that allows you to grab those prices like a mechanical edge, kind of like a dollar cost average in the future? Well, I would consider forward PEs and averages of the S&P 500 over time as a good starting point. Of course, this is something you should consider. We will continue to share this throughout our Twitter platforms, TikTok, and of course over here on YouTube. So definitely follow all of those. And this is where we're at right now. We're basically just slightly above the 16.82. Is it the worst? No. Is it the cheapest? Well, no. So at this stage, maybe you want to sit on your hands if you're an investor. It's up to you. You've got to, of course, make those decisions. Fear and greed index sitting at 74. We're not really, moving up or down too much. We're basically moving within a 6 band here. This is not necessarily an indication to sell the market. It just shows you that a lot of the breadth indicators and everything are, kind of extended, I guess you would say. If we're looking at Q4 earnings beat data, it's not bad. In fact, it went down to like 62 and now we just keep climbing up. So beat 646, misses 326, and there's a lot of this like partial beats and partial hits. So it's not the worst earnings season we've ever seen, but it is the beginning of starting to say, well, is there weakness here in the economy that needs a cut? Then when the cut happens, how bad is it really going to be? Remember, we know one thing. More people than ever before are starting to live off credit card debt. I'll try to get an updated stat on this. If anyone does have one, send it over to me through Discord or Twitter, and I'll share it with the community here because credit card debt ownership is really increasing. And why did that happen? Everybody's thought they would be able to live the same lifestyle they did during the pandemic, during all the payouts. The debt is going well above it's ever been. And this means that we're front loading some problems. And it's partially why I believe Amazon is showing such weakness this season, because the market sniffs out and it knows that it's using us as basically liquidity to get out of some positions, because consumer discretionary could be looking very, very weak in the future should this not turn out to be a soft landing. Let's have a look at the rotationals. And you'll notice here we have healthcare, we have staples, we have utilities. They weren't all in the top. Generally, we want to see defensive sectors all sitting up in the top area if we know the market's going to go low. This is not an indication here. So unfortunately for bears, you didn't get enough. We also do still have some earnings reports. Obviously, we've got PayPal before the open. That'll be the big one that's really to end this week, and a few others there. The great thing about this chart is it shows us the implied vol move based on the options. So effectively, we're expecting almost a 9% swing either way on PayPal. Always have that ready for yourself during earnings season. And of course, you can grab it over here on the channel. Do also remember to follow us on the relevant socials. And if you're interested in a newsletter we're going to start putting out, grab our 3 free trading cheat sheets and we'll put you in for that as well. And that'll be some heavy data that will allow you to make potentially better informed decisions based on some extra information. The VIX actually spiked for the first time ever. Let's get into these charts. And the first time ever, just the first time in a while. And we've made it off these lows. So of course, in 2022, the VIX was quite easy to use. We basically said whenever it was under 20, we would be able to put the SPX on top of that and start to question whether the market was potentially a little bit overbought. Now, this has been the first time that theoretically hasn't worked really easily. And a lot of people are saying, is the VIX broken because of 1 day expiry options? Well, Yeah, I mean, it could be. We'll see. We'll find out in the future. I've still got this watch the reaction. Remember, set alerts, leave them in the charts for as long as possible. But the VIX going up, the market going down, that's pretty normal. You won't see huge spikes until you get into uncharted territory or extremely large moves, though. What about yields? What did yields do over the last 24 hours? So this is something that we're all looking at. If we see breakouts, and I would suggest considering alerts above 4.5%, here for the 2-year yield. If we start to see that breakout, again, it shows us that the market is starting to change its expectations for how long we'll have to raise and keep rates high. This is incredibly important, especially to everyone buying tech stocks, and you'll need to be aware of that. You also need to know where the terminal rate is. Of course, I'm updating here on the channel, but at the moment it's sitting around 5.1%. Here's the code if you wish to put it in. And this will give you so much insight. What if we get a new high? Set an alert, 5.2. What if that happens? Well, it's not a good thing for the market, especially if the market starts coiling and we see moves into defensive stocks. That's going to be a big one. TLT over here, you can see that TLT has started to sell off a little bit. It's underneath the range. It's come down to a nice level. I still like TLT for 2023. I think it's a pretty strong play. It doesn't like raising of rates. So if you believe rates are getting to 5.5 or 6%, then of course TLT is not going to perform that well. You'll see it back down here. However, if you think that we're getting close to the terminal rate, TLT is a very interesting investment. Another one we look at is basically junk bonds. And we've got an alert set, and we actually hit the alert over the last 24 hours where junk bonds went just underneath this little low. I like to see it clean both these levels. So I've got alerts for both of them, 75, 50 and where it is right now. But this was a precursor to weakness in the market every other time in 2022. So if we tend to see junk bonds coming down and the stock market coiling, again, it's another weight of evidence towards further weakness potential in the markets. Let's have a look at the US dollar. It's back to kind of a critical little area here. Anywhere between this 61.8 and 78.6 kind of fib is going to be a big test for it. It came down to our level we discussed in the previous video. We weren't able to get a close below it. I was actually watching this, and all I wanted it to do was just a little spike underneath and then create the structure. If it had done that, I would have loved it very much because it was a clear buy at that point. But look, very strong DXY. We've mentioned this for several sessions. We have mostly buy kind of concepts on it now, being around that 10172 where it just came off. Nice little bounce that, of course, it saw. And there's that real potential for it to get back to like a 105.25 over the coming weeks. Stronger the US dollar, usually that will mean that yields are continuing to go up. And of course, it's also a defensive. So people are moving into it to defend themselves against potentially upcoming failures in the market. Or well, let's have a look at gold. Gold's maybe it's flagging. I mean, this is pretty much a traditional style of flag where you've got that huge length down and then you've currently got potentially distribution or accumulation. I'm still looking at how it reacts should it break to the low side. If it comes down, instantly spikes back up and creates something like a hammer, then I think we know that we're probably moving up to here. I still favor the sell action in this area, the 1910, 1920 zone from a technical perspective. And the consolidation in this area, yeah, it's a trend line, and sure, it's grinding higher, but I don't think we have a direction just yet on that one. Let's move over to copper. I've been very negative on copper recently. We got negative here in these blue lines. This is a pretty key thing. If copper's going down, it means the world economy is starting to look sick. We continue to watch it. I continue to remain generally bearish on copper over the next couple of months. Now, oil, this is a sneaky one. So we reached down to this low 70s the other day, and I kind of almost want to stop covering it for the time being because I do think there's some geopolitical stuff going on here. And what I mean by that is whenever it gets down to 70, it's very hard. Even though I wanted it to 65, I made the decision a while ago based on the US government not try to get it under those levels. And I think it's being shown again now with, of course, raising of rates. Theoretically, that's actually very bullish for oil. It's very susceptible to raising rates, so that's why it's pushing up. I'm not sure whether you want to hold unless you think that the rates are going higher. If you consider that they're going higher and higher and higher, then you'll probably see oil do pretty well. But it did take the low here. It spiked back up. We thought it would get into this zone, which it has. There's no turn at this stage. It's broken the downward trend line. So because it hasn't turned yet, we can't say much more about it. Be careful here on the oil trade, though. It's going to be all about yields, realistically. Natural gas fell heavily. We still haven't seen necessarily the low for it, but this is the first signs of actually potential turns. So you see that huge kind of nice pickup. The market then comes down to these extreme lows, and it basically scares everybody off. If natural gas is going to hold this level, it should theoretically start to bounce around here. It may swing the low one more time, but traditionally when you get those kind of larger increases that are fairly substantial, I mean, this is basically like a huge dead cat bounce, 13%, then when it comes back down, these are kind of where those high reward, high risk style trades are. I'm not saying trade the Widowmaker, but yeah, that's a okay kind of turn. And just like over here, you often do get bounces through that zone, but you've got to have, of course, a stop loss or an option or something that allows you to do it. Still looking for the base at this stage, just seeing the first signs. Now let's bring it over to the one that I'm sure a lot of people want to hear about on the channel, and this is Tesla. So Tesla's actually hit our expected weekly options high. It like literally flew through the set alert levels, which is both here and here, these spike zones. And I did see the rejection through the session, and I woke up this morning because, of course, I'm in Australia, and it's pretty it's pretty wild in the morning to be trading this market. And we actually saw the rejection off the zone, which I was pretty happy with. Then we saw a secondary rejection, but I was hoping that would close a little lower by the end of the day. Like, my plan was to see it go back underneath 200. Now, it didn't do that. We know there are heavy shorts here. We also know this is being traditionally squeezed at this point by retail traders jumping in on the hype train. It will eventually end poorly. Has it ended it here? Well, we're still in the extreme zone, so we'll still go with there's potential here for weakness. But if we see bullish closures and it happens on the daily, could Tesla actually squeeze its way to our next extreme zone sitting at 223? I think it's possible. We're in the big extreme zone for now. We did see a rejection off these levels, which is good, but we didn't close the daily as low as I'd like to. We'll look at NVIDIA to try to get some information about this one. Here are the options leading through to the end of the week. You'll notice, of course, the 200 strike is getting heavily called. You'll also see all of these massive amounts of calls from retail getting involved. And this is creating effectively a potential squeeze like we saw many times. AMD was one that comes to mind where it had no business going up at one stage, but I remember it just got squeezed kind of like a GameStop or an AMC would, and that was back in 2021. Here is Apple. Nothing to report. It kind of rallied and it sold off with the market. There's no distinguishable things here. We hit, of course, our watch this reaction zone, and we sold off that area. We'll come back to this one. This is what everyone's talking about, which is, of course, Google and the BARD. It dropped 7.44%, wiping almost 120 billion off the market. And it actually looked pretty weak. It comes back down to, of course, the trend line. It found some buyers there, which you'd expect it to find buyers there. Volume was pretty large. Is this sell liquidity just an excuse to allow them to get out of Google? You know, there's a lot of things to be said about Google. If you actually look at their track history, and someone in the chat might be able to say this in the comment section, the history of Google is not good when it comes to actually creating their own stuff. Stadia, Waves, Hangout, I don't know, there's a whole bunch of them. They actually kind of suck at it. They tend to acquire okay, but yeah, when they create their own thing, it doesn't tend to work out. So will this be another one for the history books? Will BARD not work and it'll take ages? We'll have to find out. Is this a island reversal? That's what a lot of questions have come in at. We've got a gap up, we've got theoretically a huge gap down, and then sell through. Yeah, you would probably call it that. This looks like obviously an island reversal. It's another negative sign for stocks across the world, and certainly something we're looking at. We also have this alert that we set for NVIDIA, which got tapped. Now, this reacted a lot more what I'd expect Tesla to react the way. It hit it, 227, broke the high, perfect, sold off, good. That's really nice. And then actually showed some weakness. So you would expect potentially rallies to be faded here on NVIDIA. Look, it's been an amazing return. This is certainly a critical zone. And I'm not big about trying to short, upward trends, but there are some evidence points to say that maybe this is, possible. I mean, of course, you've got an ABC style for Elliott wave traders out there. You've got similar leg distances, which makes sense in terms of the A, the B, and the C. So that's really nice. And you're at a critical point. This is the first time I've said Nvidia could potentially be looking short because it makes the most amount of sense. So it's another stock that's starting to look a little weak around a zone that we know is ultra critical. As we look at the S&P 500, we'll find all of that out. Let's move over to the UK 100. Little bit of a rejection wick. Obviously, we're not underneath key zone yet, so we can't call much, but yeah, we're watching it. For the Australians out there, XJO, I don't always bring this up, but I do want to bring it up a lot more in 2023. So if you're Australian, you have to subscribe. Come on, guys. You know, support some Australian US traders out there. And over here, we have the 7600, and you know that this is an extremely high zone. So basically, this is where we get that supply. It kind of reminds me of, you know, semi putting it with China stocks, because we do tend to move. Australia tends to move off China a lot. You'll notice, again, we mentioned this many, many times. I've always just said it's in supply and it looks like it's going to roll over. And for now, the China stocks are also going down. So yeah, they're both kind of synergizing very closely together. Here's the Dow. We're still in the trend, or we're still in the triangle. So we haven't seen a breakout high or low yet. We'll come back to that chart, but I want to show it to you. The US 100 now, this is where things get a little bit more interesting. The Nasdaq came down to a bit of a fib pullback within that kind of 61.8 kind of area, a little bit lower than that, and it's starting to try to form base. Now, if you look at the structure of the base in the futures market, we actually found a low, we found a high, we found a lower low. So we're very interested in what happens here. What happens around this 12,577 over the next 24 hours, should we break that, will be pretty important for bulls. If you're feeling bullish, it has to kind of go here. If we start getting underneath these lows again, then we move towards the trend line, which you can plot on your chart. So it's now for the bulls. The bulls have to push. They need to push, pull back maybe, and then resume. So it's a very important point for markets. And we've seen weakness. We've seen all of this weird action that we got from Jerome Powell's speech. And now we have some key structural levels. Let's move over to the SPY. As we mentioned at the start of this video, it hit expected weekly options highs, tapped off them. This is why we use those expected weekly options highs and lows. If you can bring them in with other reasons, they can be great. Where do we trade? In the middle. We'll look at the options in a minute, but we're trading in the middle. It looks like anything to 400 to 405 is possible. Here are our two extreme zones. We've talked about them a little bit here on the channel. We still have a lot of unfilled gaps to the upside. We are still in an upward trend, so you cannot deny that. You know, bears, you're mostly looking at this from an extreme zone and kind of guessing that it's going to go down. Let's now have a look at what we've got going on with the S&P 500 futures. So similar to the other one, we've pulled back, which is good. We've, of course, seen that huge rally. This could have been the stop. Well, this was a stop loss hunt, but so was potentially this. So we do have the conflicting signals. I tell you, this rally here, it's a very strange one. That was expected. This was are we still in a bull kind of run? So we sold off to the level we would expect. We have, of course, a rally. We have a drop, and we potentially have a rally coming through. We don't know if it's going to get there. So we want to set our alerts for some key levels, and we're going to do that at 41.37. And if it does break through there, then for day traders, they potentially may be starting to look for potential longs. Of course, that would mean this is a coil. If it breaks out, well, you can't be a denier. It could move before and go through a lot of levels. As we know, the evidence starts to state that things like Nvidia, things like Tesla, so many stocks are at either middling zones or critical zones that it can make sense for both players. And that's what makes this zone so confusing. Some people choose to just literally sit out of these areas, and I don't blame them because it's a very, very tough area. If you think about it, it's not really one of those zones where you're very clear on which way you're looking. And that's why sometimes options is the best play in these areas, to allow stop loss hunts to happen, to allow levels to be broken and then brought back forward. And at least then you can fix your own risk. So yeah, some key levels there, and I thought we'd bring them through. Let's now refresh the options market leading into the 10th and take a look at what's changed over the last 24 hours. Not much, realistically. We still have those 410 calls, the 415 calls, and the 400 puts. So if I was the Wall Street boffins, I would like to close the market at 405. Now, of course, it says here Max Payne's 411, but I feel like 405. So the reason why is just because you've got those big 410 strikes, and in the middle of these two levels, you could certainly sit there. I think anywhere around where the current price is makes a lot of sense, though, for the close. We've got that potential coil in the market. Don't make a decision yet. Let some kind of liquidity event create it and then go from there. So individual stocks could still be the best ones to trade through. Bitcoin, there's nothing going on. It's so boring. Dull market, obviously new highs being rejected. No new low underneath 22,289. I sound like a broken record because I am here. Set alert here. These are all key zones. If we move over to Ethereum, it's really the same thing. We're just basically trashing around these highs, slightly coiling up. Could we be building in a position? It's possible, but we haven't seen it react with the key levels yet, especially Bitcoin, and that's the one that tends to lead it. Let's have a look at the news for the week ahead, and it comes down to probably prelim UOM consumer sentiment on Friday. There's not too much information coming through here at this point, but as we know, prelim UOM consumer sentiment, 10 a.m. New York time, will be worthwhile looking at. If you enjoyed this video, subscribe, smash that like button, and of course, follow us on the other social medias. We will be releasing a whole bunch of TikTok videos moving forward as well. If you're interested, don't worry. This daily show is not going anywhere. This is where, you guys have really supported us, and I love doing this show. So I hope you're enjoying it, and we'll see you over on one of our social medias as well. Catch you for now. Bye.